Yeah, so hope everyone's enjoying the content so far. I think some of the comments on the last panel actually feed well into a conversation about trading protocols. So allow me to first introduce the panelists. First, we have Russ Bednick, who serves as the U.S. and EMEA head of credit trading for global wealth management at J.P. Morgan, and he's been with J.P. Morgan for over 13 years. Vidya Guruju is director of product management at Charles River Development and is responsible for their fixed income order management functionality. And he's been with Charles River for over 8 years. And Peter Bortelsman is the president of ICE Bonds Division of Intercontinental Exchange, and he's been with ICE for over 7 years and focused on their fixed income products. And again, I'm your moderator, Spencer Minlin. I'm in the capital markets group at the independent research firm IT Group. So the theme we've been asked to talk about, guys, is about assessing the impact of different types of trading protocols, right? And which initiatives help trading desks kind of transform the way that they focus and prioritize their efforts, focus on transparency, automation, post-trade requirements, and how can different types of trading protocols or automation tools like algos become a larger and more important part of liquidity and sourcing liquidity. So we have a couple of themes we've touched upon, but Russ, I'm going to ask you to sort of kick us off here. I think we heard some interesting comments on the previous panel about how hard it is to get the job done on the buy side, and some of the challenges around market fragmentation, data management, illiquidity struggles that still a lot of trading desks suffer from. And the comment was made about finding the right fit of the trading tool or the protocol for the use case. When we used to talk about trading protocols, we were talking about voice, fax, chat, email, or fix, but now we have a whole bunch of other different protocols depending upon the type of instrument or the trade, algo, PT, RFQ. Russ, could you sort of, kick us off and just talk about sort of what it means for the right fit of the different type of protocol for the type of trade?
Sure. So I think you hit on a key point there, which is you really want to have a toolkit that has multiple different protocols. Depending on your product set, that can vary quite a bit. I think we've seen the most evolution kind of occur over the course of the past few years. Portfolio trading has been talked about quite a bit, but I think the advent of all-to-all trading has been really helpful. We still use various forms of bilateral trading, which can be simply voice trading. It can be streaming RFQs or prices with direct fixed API connectivity, which has become much more commonplace for us over the course of the last year or two. As well as the traditional RFQ. I think there's been a little bit less uptake in terms of some of the session-based or dark pools, at least from our perspective. But RFQ is still probably the most popular tool within our ecosystem.
And Vidya, when you are thinking about building out new functionality for fixed income, you've been doing this for a while. Above and beyond just trade execution via fix, and now we've got RFQ. When you think about all the different types of client workflows and different protocols, if you had to compartmentalize, we have this type of protocol, and that. What are the different sort of buckets of trading protocol functionality that Charles River is delivering? I think Vidya, you're on mute.
It's a few different things. One is, of course, to provide the choice to the client, right? And that in itself will challenge the sense of keeping ahead of what's coming, right? And predicting what's going to go take off and what's not. And a couple of things help. One is, staying in close touch with our partners, whether it be ICE Bonds, True Market Access, Tradeweb, can understand their roadmap and then take that market intel and discuss it with our clients and validate it with them. And that kind of feedback definitely helps. And then it's not also just about creating the plumbing and providing access to the traders to different protocols. To your question about compartmentalizing, right? It's one thing to provide the plumbing to access these protocols, but also we don't want to stop there. We also want to get their data. I mean, their data has been a very prominent, I think, theme all along this conference. We also want to get the pre-trade data from these different vendors and use that data intelligently, whether it be in order classification, trade automation, or bringing out some of the analytics that help the traders truly understand what's the best protocol to use in a given situation in a given market. Without that, we feel like, once we connect with all these different liquidity pools, it still looks like a very fragmented market, right? Especially with the proliferation, it actually looks more and more fragmented unless you have the capability of bringing in the data, which is one part, but then also layering on top of that analytic tools that kind of make sense of all that data. And in that case, once you are able to do that, it feels like, you're complementing, not just, fragmenting the liquidity. I'll let others comment on it.
Yeah, appreciate that. Peter, when both of these comments have talked about, the using the right protocol and then the market fragmentation, making it an interesting challenge to, to source liquidity. From a venue's perspective, how do you think about architecting the, a protocol to in order to optimize workflows, the different types of trading instruments, and the different type of protocols to attract liquidity to come to a market center?
Yeah, it's a great question. And I think you hear some of the points raised on this panel as well as others. It's improving the workflow and giving that choice. And I think what we've seen over the course of the pandemic, and the data theme, continues throughout, is ensuring that you have the liquidity, but also the data to help with execution decisions. But it's not just having the data available, it's making sure that that data is reliable, it's actionable, to make trading decisions as easy as possible. And I think as you look through the pandemic, where the most precious commodity has been time, enabling people to make decisions quickly as they're in a fragmented environment logistically, when you're not along the trading desk and you can't engage with your colleagues or work with your trade support, instituting that infrastructure to make sure that decisions can be made accurately and quickly is paramount.
So Russell, going back to you about utilizing data and automation, one of the we keep talking about going back to having the right data with the protocol. Could you talk a bit about what's really been on sort of the cutting edge the last 12 months that you've been working on? Obviously, the desk has been challenged because of everything we continue to talk about, but in terms of optimizing automation, where really has there been a lot of effort to push the ball forward with automation?
Well, I think there's a continuous process on behalf of a lot of buy-side firms to try to improve the quality of your data. So we've spent a lot of time over the last 12 months just trying to cleanse the data on a post-trade basis, even to ensure that we're meeting all of our regulatory obligations first and foremost. So this best execution as a process rather than a destination is something we often talk about. And a lot of that has been automating the best execution data to the point where it's easy for a trader to come in after the trade and ensure that they believe that the market snapshot as well as their regulatory obligations are met. And then we can learn from that data and incorporate it into our decision-making on a go-forward basis. So we spend a lot of time continuously trying to improve the quality of that post-trade data. And then, like has been a common theme throughout the discussion today, has been trying to find the right ways so that we can get pre-trade data that comes from the market or from the different vendors, ATSs, et cetera, to align more with the objectives of our different portfolios or investment needs at that time. So there, more recently, we've started to look at things like liquidity scores to try to identify, through screening tools, where opportunities actually are in the market. That's going to happen in conjunction with axes and more direct dialogue from dealers. So through liquidity scores that kind of capture overall market opportunities and the ability to screen through those, coupled with axes and then the ability to set watch lists through things like all-to-all trading, I think the life cycle of a trade potentially has gotten a lot shorter because you're able to match up your objectives more quickly with what the market has available.
So you started touching upon some of the different types of trading protocols and the venues. Getting the data and getting that circular reference so that when you're making a trading decision, obviously is key importance. You talked about post-trade data and pre-trade data. Circling back to then when it's time to actually trade, we've been talking about PT, we've been talking about electronic repo. You mentioned all-to-all trading. What are some of the types of data or some of the enhancements to decide what is the appropriate trading protocol? What's the appropriate venue? Has any of that evolved as you're thinking around using a different venue or the different type of protocol change over the last sort of 12 to 18 months?
Yeah, it really depends on the asset class. So I oversee cross-asset trading. When you look at something like equities, it's highly commoditized and you have a very developed market structure, although it's going through some changes and debates over the last 6 months. You've got the ability to use machine learning and kind of very standard and accepted algos to place trades into the market. So you're really able to match the specific security with counterparties to recommend certain types of execution depending on the time of the trade, the size of the trade, et cetera. We haven't gotten there in fixed income, but we have started to use some of the tools. So we've incorporated a smart order router in treasuries. I think that'll eventually grow into investment grade credit that takes advantage of the growth of algorithmic trading and streaming single dealer pricing. So we're starting to resemble something more similar to a central limit order book in credit. So I think they'll evolve, but for now, we still rely heavily on counterparty management through post-trade analysis, dividing fixed income into sub-asset classes, analyzing counterparty execution quality on a quarterly basis, and then making decisions about how do we want to execute, who do we want to choose, how many do we want to choose at once, and we end up using all of the tools within the toolkit.
And Peter, I'd like to ask you to continue that thought, to add something to that. Or Vidya.
I think Russ is spot on. And as you see, the market's evolving and the need for data and these new protocols, whether it be portfolio trading, which is quite topical, or all-to-all, which is topical but has been around for quite some time, but more on the retail side or odd lot activity. As people are embracing these new protocols, as the market continues to evolve, again, it goes to that theme of needing that data. But I think Russell made a great point. The fixed income market is just so wide and diverse. You'd love for it to be equity-like, but I think there are a lot of challenges for people to achieve that. There obviously you can focus on that in the more liquid areas. But I also think one of the things that you're seeing is that's fueling into these different protocols is the emergence of fixed income ETFs and the importance that they are starting to play in the market, and how that changes how people are adopting their data needs and their trading needs.
That's a great point. I mean, sometimes people don't appreciate it, but the whole create redeem is in effect a trading protocol, right? The way that that you take up the basket, go to the AP, convert it back. That's probably another protocol to add into the trader's toolkit. So I do want to remind the audience, please submit questions. We have one that came in. Russell and Vidya, I'm going to ask both of you maybe to comment on this. And it's appropriate, Russell, given some of the comments you made in our pre-panel conversation about sort of using best of breed tools and maintaining multiple desktop systems depending upon for the right use case. So the question is, do you work with a number of different tools? What are you using? Is it better to have one or two, some doing better job than others? It's a real sort of targeted question.
Sure. So we've got our own proprietary OMS that's closely integrated with our EMS. So we have one centralized EMS, and then from that, we've got direct dealer pricing that comes into that, as well as the integrated functionality to send out RFQs to some of the larger technology platforms that are used within the market, as well as single inquiry, all-to-all trading, or obviously RFQ to the broader market. So I would say a decent amount of trading still occurs through scraping messages ahead of time and voice in the less liquid products. But for things like investment grade credit, treasuries, agencies, et cetera, that's either routed out to the market through use of a smart order router that's built into our EMS, or through RFQ or inquiry format out to the market directly via the EMS. So one central hub that's taking in pricing on an aggregated basis across both dealers. And I should mention that all of the ATSs or the larger ATSs in the market, that pricing is also aggregated with single dealer pricing. So it ends up resembling a stack, I think, as much as you could envision that within fixed income today.
Vidya, a lot of fixed income trading desks rely very heavily on your company's software, both for on the OMS side and the EMS side as well for fixed income. What are you generally seeing? What's the ecosystem on trading desks today?
It's fast expanding at an exponential pace. So to Russell's point, connectivity is key. We believe in providing the choice. And depending on the type of client, the type of strategy, the type of asset class that they're trading, they may be dealing with only 2 or 3 different venues at a time, but as an OEMS provider, we have to connect and certify and provide smooth workflows to all these different vendors. And we look at ourselves as a platform. And we consider, all the different venues, the market data aggregators, et cetera, as our partners. And together, we want to present this ecosystem to our clients. And what we want to, however, do is ensure a smooth workflow when we're doing this, where things can be automated, where things can be automatically routed to a certain destination. We want to be able to do that. Where we can remove the pivot to different venues, we want to remove that. And again, in partnership with our partners. So it is not easy, or it's actually quite painful to have to go to different places to find liquidity. And that's the problem we're trying to solve through market data aggregation, providing the right analytics. And also in terms of trading too, it doesn't have to be that. It always has to be a staging workflow where from your EMS, you're staging an order to a venue and then pivoting to the venue to complete the order. To the extent possible, we're trying to bring in that entire workflow into Charles River, again, with partnership with our clients. And as the number of different providers in the industry is growing, I think everybody is becoming more and more open to that kind of a framework where Charles River is saying, not everything has to be in Charles River, right? We want to partner with different providers. Likewise, our partners are saying, we don't need the eyeballs on our system. It's fine if they use it as a platform and they access it through an API.
Thank you for that. Peter, I'm going to ask you to, we're running short on time. I'm going to ask you for sort of final thought on this last question that, that we're going to talk about. As protocols change, some things change. Like I started out by saying voice, chat, now electronic. The question, this came up in the previous panel also about relationships, sort of the balance between best execution and relationships that traders have to sort of manage. Where do you see that going as protocols change over time?
Yeah, it's a great question. And I think that's why you've seen a little bit of uptake to the all-to-all, to Russell's point, and maintaining that relationship is part of the reason why you haven't seen broad adoption yet. But as people warm up to that and get a better understanding of how that impacts the relationship, you see more of a shift. But I think there will always be that element of, maintaining that client to liquidity provider relationship, so you can go and, identify, best people tend to say is not necessarily the best price on the screen. There's more to identifying what the best price or the best execution is. So evolving those workflows, I think, Jake mentioned it on the point below, figuring out how, from a portfolio trading perspective, how you can allow for those relationships to continue while continuing to bring value to sourcing liquidity, bringing efficiency to the workflow. So it's working with our key partners to figure out how that works from a workflow perspective and incorporating it into either existing protocols or new protocols that may, evolve or be created over time.
Thank you for that. And thank you again to Russell and Vidya for participating and making my job relatively easy here. And WBR, thanks. And I'll hand it back to Kevin. Kevin, take it away.
Great, awesome. Thanks, Spencer. Thanks, guys. Great conversation. Yeah, so quickly moving on.